Want to be a shareholder in a world-class business, benefiting from secular growth, looking for a market-beating yield and double-digit dividend growth? Like the idea of buying a high-quality dividend growth stock after it's plummeted by more than 30%? Then you have to check out today's video. Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is the largest home improvement retailer in the world. The American dream, homeownership. The two are practically inseparable for most people. And what does that mean? More people buying more homes, which are, of course, physical structures that naturally deteriorate over time and need constant upkeep. That leads to more demand for the products that this company sells, which means higher revenue, greater profit, and a growing dividend. I personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explain exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Home Depot Inc., which appear to be trading at a significant discount today. Home Depot Inc., stock ticker HD, is the world's largest home improvement retailer. Founded in 1978, the company is now a $278 billion by market cap retail juggernaut that employs almost 500,000 people. They operate over 2,300 stores across the US, Canada, and Mexico. More than 90% of net sales occur in the US. The typical store averages approximately 105,000 square feet and offers more than 35,000 products. Their e-commerce channel offers 1 million products. We have a lot going on right now, and much of it, at first glance, seems negative. China is locking down major cities, the US may be on the cusp of or even in the midst of a recession, our global supply chain remains in disarray. But what do all three of these issues have in common? They're all short-term problems. However, investors must maintain a long-term perspective. If you ignore the noise and look past short-term bumps in the road, you'll see that great businesses positioned in secular growth areas of the economy will almost certainly thrive over the long run. Home Depot is a perfect example. What could possibly be more secular than the need for shelter? The global population continues to expand, and these future human beings will all need somewhere to live. And we're not just talking about somewhere to live, people want their shelter to be a home. Well, that's precisely where Home Depot comes in, offering thousands of products to improve and beautify one's abode. After all, it's called Home Depot, not Shelter Depot. Furthermore, homes are physical structures that naturally deteriorate over time. That means routine trips to the local Home Depot in order to purchase various products for maintenance and repair. All of this adds up to Home Depot being in a great position to continue growing its revenue, profit, and dividend for many years to come. As things stand, Home Depot has increased its dividend for 13 consecutive years, and I think they're just getting started with that. The 10-year dividend growth rate is an astounding 20.3%, although more recent dividend raises have been closer to 15%. Along with the double-digit dividend growth rate, the stock yields a market-beating 2.8%. This yield, by the way, is 60 basis points higher than its own 5-year average. And with a healthy payout ratio of 46.7%, Home Depot's dividend is set up to continue growing at least in line with the business, if not faster. I like dividend growth stocks in what I refer to as the sweet spot, a yield of between 2.5% and 3.5% paired with a high single-digit or higher dividend growth rate. This stock gives you both a sweet yield and a very sweet dividend growth rate. Looking at business growth, Home Depot increases revenue from $74.8 billion in fiscal year 2012 to $151.2 billion in fiscal year 2021. That's a compound annual growth rate of 8.1%. I tend to look for a mid-single-digit top-line growth rate from a mature company like this. Home Depot blew my expectations out of the water. Compounding revenue at this kind of rate from a $75 billion base is exceptional. Meanwhile, earnings per share grew from $3 to $15.53 over this period, which is a compound annual growth rate of 20%. Truly extraordinary bottom line growth. What's remarkable here is that EPS growth and dividend growth line up almost exactly over the last decade, demonstrating incredible prudence from management. A mix of margin expansion and prolific buybacks spurred a lot of the excess bottom line growth. For perspective on the buybacks, the outstanding share count is down by 30% over the last decade, and the company recently authorized a new $15 billion share repurchase program. Looking forward, CFRA is forecasting that Home Depot will compound its earnings per share at an annual rate of 4% over the next 3 years. CFRA's forecast for near-term EPS growth is well off of what Home Depot produced over the last decade. Is this kind of slowdown realistic? I think it is, albeit with the caveat that I see it as a temporary phenomenon. It's a bump in a road that is otherwise nearly flawless. Indeed, Home Depot's own fiscal year 2022 guidance calls for mid-single-digit EPS growth. This comes down to what's been a pull forward in sales over the last 2 years. Home Depot has been a beneficiary of certain pandemic-related events. Some people decided to flee cities because of health concerns, lockdowns, and/or family or space needs. Many of these people bought larger homes in suburban markets. Simultaneously, the work-from-home trend took off in a big way, partially out of a need for businesses to adapt to the pandemic, which left people craving more space at home with office setups. It's not hard to see how this was a perfect storm, leading to an explosion in demand for Home Depot's products. And it's important to keep in mind that Home Depot disproportionately benefits from favorable industry dynamics. The company operates within a powerful duopoly. Lowe's Companies Inc., stock ticker LOW, is the only serious competitor here. Now, let's be clear. While some of the pandemic-induced trends are apparently behind us, the desire to own one home isn't a trend. Home ownership is a lifelong dream for many Americans. In addition, the work-from-home situation seems to be sticky. That said, it's unreasonable to expect the results over the last 2 years to persist indefinitely. Once certain home improvement products have been bought and once certain home improvement projects have been completed, that's it. There are only so many kitchens to remodel, decks to build, and home offices to fashion at one time. Even if we accept CFRA's forecast as a base case, I still believe Home Depot offers a lot to like. Expanding the payout ratio ever so slightly could support high single-digit dividend growth in an environment where the company's earnings per share is only growing at a mid-single-digit rate. Keep in mind, this is only a near-term situation. If we widen our aperture and look at Home Depot's growth profile before the pandemic hit, they were doubling EPS roughly every 5 years. The earnings power here is special. I don't see why they couldn't return to this kind of growth once the world fully normalizes, which would set the dividend up to grow at least in the high single-digit range over the long run. Coupling that with a 2.8% yield is awfully appealing. Moving over to the balance sheet, Home Depot has a great financial position. The long-term debt-to-equity ratio is not applicable. Buybacks have led to a high amount of treasury stock, which has created negative shareholders' equity. However, total long-term debt of under $40 billion is unconcerning for a company with a market cap of nearly $280 billion. Moreover, an interest coverage ratio of over 17 shows no issues whatsoever with servicing debt. Profitability is impressive, especially considering the fact that retailing is typically a low-margin industry. Over the last 5 years, the firm has averaged annual net margin of 10%. There is no measurable return on equity because of negative common equity. To offer some context to the margin expansion story that's played out, net margin was routinely coming in at between 6% and 7% at the start of the last decade. Home Depot is a terrific business, and with large economies of scale, pricing power, brand value, product specialization, and a differentiated workforce that guides consumer purchases, the company does benefit from durable competitive advantages. Of course, there are risks to consider. Regulation, litigation, and competition are omnipresent risks in every industry. Retailing, in particular, is an extremely competitive industry, but Home Depot's status as the clear leader within an entrenched duopoly mitigates competition. The company has exposure to economic cycles, as spending on homes and home improvement is partially reliant on economic confidence, strength, and expansion. Housing supply/affordability remains an ongoing issue in the US, but people living in older homes actually bodes well for the company. Pent-up demand for services in a post-pandemic world could lead to less spending on products. Most of the company's stores are located in the United States, limiting growth potential and geographic diversification. A hot U.S. real estate market has been cooling of late, which would likely negatively impact the demand for general spending on homes. It's worth bearing these risks in mind, but the quality and promise of the business should also be considered. And after the stock's jaw-dropping 35% drop from its 52-week high, the valuation is more attractive than it's been in years. The stock is trading hands for a price-earnings ratio of 16.7. This is a stock that has usually commanded an above-market earnings multiple, but it's now flipped to a below-market earnings multiple. This is also well off of the stock's own 5-year average PE ratio of 22.9. We can also see that the price-to-sales ratio of 1.8 is measurably lower than its own 5-year average of 2.3, and the yield, as noted earlier, is significantly higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 8%. That's as high as I'll go with a long-term dividend growth rate, but a business of Home Depot's caliber deserves this designation. The company has clearly shown an ability to grow both EPS and the dividend at a higher rate than this over a long period of time. While a pull forward in sales seems to be causing a temporary slowdown in growth, I don't see anything here that indicates a permanent impairment. With a moderate payout ratio, the company should be able to sustain high single-digit dividend growth until the business normalizes. After that, there could be an acceleration in dividend growth. I like to err on the side of caution, but I think this is the rare kind of business that can actually exceed lofty expectations over the long run. The dividend discount model analysis gives me a fair value of $410.40. The reason I use the dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since a dollar tomorrow is not worth the same amount as a dollar today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates Home Depot as a 3-star stock with a fair value estimate of $267. CFRA rates Home Depot as a 4-star buy with a 12-month target price of $365. I came out high this time around, which surprises me. Nonetheless, none of us view it as expensive. Averaging the three numbers out gives us a final valuation of $347.47, which would indicate the stock is possibly 28% undervalued. Here's the bottom line, guys. Home Depot Inc. is a world-class retailer taking advantage of secular growth and benefiting from being the clear leader within a powerful duopoly, with a market-beating yield, double-digit long-term dividend growth, a moderate payout ratio, more than 10 consecutive years of dividend increases, and the potential that shares are 28% undervalued. Long-term dividend growth investors should seriously consider buying the drop on this high-quality dividend growth stock. And now for a special news announcement. Unfortunately, the war in Ukraine seems to be picking up steam after Russian President Vladimir Putin announced a partial military conscription. Bad news for the world, but good news for defense companies, which will almost certainly see even more demand for their products and services. For example, we covered Lockheed Martin Corporation, stock ticker LMT, recently, estimating intrinsic value for the business at almost $450 per share. In this environment, defense companies like Lockheed Martin can and should do well. If you are a long-term dividend growth investor, these names cannot be forgotten about, especially in this environment. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also, take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.